for another day. We thank you for another opportunity just to say thank you. Lord, we always want to be mindful of your grace and for your love and for your mercy. And we thank you for all of that. Lord, there's nobody greater, and we want to acknowledge that. And again, just say thank you. We thank you for this class. We thank you for those who have shown up to listen to what we have to say this evening. And we pray that they will be like a sponge and absorb all this good information that's free to them, and hopefully that's going to make their lives much, much better. So, Lord, if you do that for us, and we'll be so careful to give you all the thanks, all the glory, all the praise, and all the honor. In Christ's name, amen. All right. So tonight we're going to be talking about credit. So the idea is that before you leave tonight, you will have all the information to make sure that your credit score is where you want it. And where I would like to see your credit score is up around the 800 mark. Okay? 800, 825, 850 is the max, by the way. So 825, 830, 840, I'll settle for 840. All right, will you settle for 840, 830, 825? All right, cool. So we're going to give you some tips that will help you get there. Again, my name is Marcus. Work for Arvest Bank, obviously. The name tag kind of gives it away, the shirt, all this good stuff. But we're pleased to present this tonight to you. We've presented this class for about 10 years now. And so we've got a lot of feedback that is helping folks improve their credit score. So we're just glad to play a small part in helping that cause. So without further ado, I got a couple of things I want to mention first. First up, so Arvest Bank wants you to know about your credit score, how it's used, how it's calculated, all that good stuff, and how to maintain a good credit score. We obviously have branches all over Central Arkansas to help you with your financial needs. So if you have questions, just pop into any of our branches. We'll be happy to sit down with you and talk over your options. Big time disclaimer here, we're not credit counselors, so we have to say that all this information is publicly available, so it's not that we have a monopoly on this information. All we do is we compile it for you, put it in a format that is easy for you to digest, and but it's not. We're not credit counselors. Everybody's situation is different. So if you're sitting there thinking, okay, my credit score is 799, and my friend's credit score is 640. There could be a lot of reasons for those differences, so just know that everybody's different, everybody's unique. Every credit score could be different. For example, if you pull a copy of the various credit reports that we'll talk about here in just a minute, you will see that sometimes the credit scores are different, and sometimes it's a timing issue, and sometimes it's a credit history issue. So basically, a credit bureau is really just a company that collects information and serves as a reference for you. So financial institutions, banks, credit card companies, what they do is this information is made available to them, to us, on you, so that we can build a picture of how you pay your debts, hence how you're going to repay us. So if you've not paid others that you borrowed money from, and you approach a bank, then banks are going to be less likely to loan you money if you haven't paid back money that you borrowed from others and paid it back on time. So, but basically, credit bureaus, they're just a collection agency or a information collection agency. They compile all the information and just make it available to creditors. So there are three major credit bureaus. So there's Equifax, TransUnion, and Experian. So again, if you pull a credit report from each of these different agencies, the score could be different, but don't let that bother you. That's normal. There is a website that's called annualcreditreport.com that you have access to. It's free. You can pull a free copy of your credit report as often as you want to. Historically, it was called annualcreditreport.com because they only allowed you to pull it once a year, but that's changed now, so you can pull it as often as you want to. So annualcreditreport.com, I encourage you to pull a copy of your credit report and take a look at it. All right? Questions so far? Okay. Well, let's jump into the meat of this. So basically, when you pull your credit report, this is just a sample, and it's available online, by the way, for those of you who are watching online. It's at smark.org. You can pull a copy of this entire presentation. But basically, the first thing that you want to do is make sure that your personal information is accurate. So you want to make sure that small things like your name isn't misspelled, your address is accurate. Maybe if you recently moved, make sure that your new address is there. Make sure that your social security number is correct. Believe it or not, all those things, if they're wrong, they can impact your credit score. Also, it could inadvertently put some type of fraud alert on your file as well, because if a bank or a financial institution is looking at your information on your credit application that you filled out and the social security number, for example, is different, then that could delay the process, and it could raise a red flag that, okay, maybe this is not the same person. So it seems small, but it's very, very big that you make sure that your personal information is correct. And that's the first thing I always encourage everybody to do. So with that, the next thing, public records. I'm going to fly through this credit report stuff kind of fast, but if you have questions, please feel free and stop me. But the reason why I want to get to the good part is because I want to show you what actually makes up your credit score. Okay, so I don't want to miss that. And last time we kind of ran out a little bit of time, so I want to make sure that we get to that. And if we need to circle back to this credit report, I'm happy to do so. But just know that there are also public records information on the credit report. So data collected from court records like civil judgments, public filings, things like that, they negatively impact your credit report. So just know that when you see these public records on your file, especially things like civil judgments and tax liens, they could negatively impact your credit score. So you want to make sure that in addition to the name and address and all that good stuff, that you don't have things like this. And if you do have things like this on your credit report, it's not the end of the world. We can work through those things. You just need to sit down with somebody and talk through ways to help clean some of those things up. So those are public records. You also have adverse accounts. Historically, medical bills were the biggest issue that a lot of people have, but going forward, since last year, one of the rulings came out that banks are not using medical debts or records or negative information about medical collections against you now. So we don't factor that in when we're looking at extending credit anymore. So that's a good thing. Because again, sometimes the information was wrong. You had to fix it. It took a long time to do so. So that was actually a really good change that's in the favor of you guys, the consumer, so that banks don't use that information anymore in the credit decision. So that's a huge plus. All right, so talk about adverse accounts. So let's talk about satisfactory accounts. Real simple. Now they use this little chart up here that's if you have paid on time, it simply says okay. If you pay 30 days late, which I do not recommend, don't pay 60 days late, don't pay 90 days late, but it's real simple now. It's 30, 60, 90. So you can tell really quickly how, if you have any past due accounts, how far past due you paid. So you want to see okay up there a lot. As a matter of fact, you don't want any 30, 60, 90s because that would actually pull your credit score down. And it's important to note too that there is an X in some boxes up there. If you notice, just know that a lot of times, reporting to the credit bureau is voluntary. So a lot of companies, they have the option. Companies have the option to report, and so some companies just may not report. For example, if you purchase an automobile from one of those buy here, pay here dealerships, I would ask them, do you report to the credit bureau? because you want to make sure that every payment that you make on time, that you get credit for it. So if they don't report, it doesn't mean that you may not buy the car, but you might rethink whether or not you want to use that particular dealership, because again, if you're trying to increase your credit score, every payment that you make on time helps you. And so if you're making payments on time to this car lot or company and they're not reporting to the credit bureau, then that's not helping you. So just make sure that that's a fair question to ask, and it's a question that they get a lot. So any questions so far? Yes, sir.
How soon should you make a payment to where it raises your credit score?
So the question is, how soon should you make a payment to the point where it raises your credit score? So it's kind of a trick question. You always say pay on or before the due date. It's okay to pay early. I'm glad that you're thinking paying early. The thing that you need to be concerned about is if you're paying to a creditor early, you want to make sure that you direct those payments the way that you intend. For example, if you have a credit card and you're trying to pay down the principal, so you want to make sure that if you're trying to reduce the principal, that the payment that you make actually goes to principal. And so the more principal you pay down, the less interest you pay over time. So if you want to just simply pay a payment ahead, that's fine. That's called a regular payment. You can just make a regular payment, and you can make that 15 days in advance, 20 days in advance. I wouldn't recommend probably paying earlier than 30 days in advance, unless you want to. I mean, it's okay. Nothing wrong with it.
Is it okay to just let's say that you get something on credit, but you already have the money? If you get something on credit, but you already have the money, is it okay to just pay off the total amount like a week later?
I wouldn't do it a week later. I'd probably let a billing cycle, which is typically 30 days, 31 days. I would pay it after 31 days. But yes, and we'll talk about that. If you pay the full balance each month, that's actually going to help you as long as you're paying on time, assuming you're paying on time. Yes, that's a great strategy.
Thank you.
You bet. Other questions? Okay. Let's wait for a microphone so the online audience can hear us. Thank you.
Piggybacking off what he was asking you, would it not be ideal, if you can, to just set those up automatically?
Yes. So automatic payments is another option. As a matter of fact, at Arvest and most banks, if you choose an automatic an auto payment or auto draft, they'll actually give you a discount on the rate by 25 basis points. So a lot of banks will do that. And actually, that would also help ensure that you make your payments on time, because they'll be automatically drafted every month on the due date. And so that ensures that you're not late. Plus, you could potentially get a break on your interest rate. It all depends on what your credit score is. Yeah, good question. Other questions? Yes? Oh, okay. Kind of like an auction, though. If I see some, peripheral, I might call on you, so no. Question? Let's wait for a microphone real quick here to make sure the online audience hears the question.
Okay. How do you feel about people who they may pay a credit card off, and then they just say, like, I don't want to deal with it no more. I just want to close the account. Like, how do you feel about that?
Yeah, so just know that part of a factor of your credit score is the length of credit history. So we always say, if you want to pay off a credit card, that's fine, just don't close it, so that you can get that good history. Then every time you use it going forward, then that creates new history and better history, again, assuming that all the payments are being paid on time. So we always, unless you just have to, if you have too many credit cards, that's one thing, but we always say try not to close the accounts out, because you lose that good history that you paid. Yeah, it depends. So the question is, how many credit cards are too many? It depends. You really don't need, in our opinion, again, it varies from bank to bank and probably from person to person, but typically, if you have 3 credit cards, depending on what you're using them for, that's a good cross-section of, history, but a lot depends. You can actually have 1 credit card and it'll do you just fine, as long as you're paying the monthly payment on time, and you're not charging the balance up to near the credit limit. And we'll talk about that here in just a little bit too. Question?
Okay, let's say that you pay off a car, or you get into a wreck and your bank, the bank that you finance through, they pay off the car. Is that why you're getting penalized whenever you pay it? Like, typically, like whenever you pay off the car, or let's say your bank pays it off if you have a wreck, your credit score drops a lot of it. It seems like, or more than what you're probably used to. Is that because, are you getting penalized because the account is being closed, that credit account is being closed, or that line of credit is being closed?
If you're no longer, so yes, and that's the fast answer is yes. Just because that balance gets paid off, and so the amount of credit that you have in total decreases. And so the amount of credit is a factor in your credit score. Yeah. Now, most of the time, if you wreck a car or you have an accident, then you'll probably get another one at some point, hopefully, and then you'll have more outstanding credit that's going to help you with the new car payment, new monthly payments, and things like that. Yeah. Other questions? Great questions. All right. So again, you want X's. You don't want to see too many, but they're not going to harm you. It's just that you're not getting credit for those payments being paid on time. If you have an X on your history, just because that particular company just doesn't report to the credit bureau. Okay, so credit. Let's talk a little bit about credit inquiries. So there are two types of credit inquiries, and basically, when you apply for credit, and at a bank or a credit card, or if you want to rent an apartment now, if you want to purchase insurance. Typically, they're going to pull a credit report on you because, again, they want to see how you pay your debts historically, because that's an indication of how you might or might not pay them. So they want to know that. So there are soft inquiries, what we call regular inquiries, and then there are hard inquiries. So basically, soft inquiries are typically used by credit card companies when they want to extend an offer to you for a new credit card. Like, you might get a credit card letter in the mail that says, hey, you're pre-approved for a $2,000 credit card. So they pulled a soft credit on you to see if you're eligible for a credit card. So a hard pull is when you go in and physically apply for credit, you sign the application, and then you authorize the creditor to pull information on you. So soft pull is typically these are companies that are looking to extend credit to individuals, so they'll pull a soft pull. It does not impact your credit score, and it does not negatively impact your credit score. Just know that if you have a hard pull, for example, if you want to buy a car and you go to 3 different dealerships, just know that each time they pull your credit, it's going to pull your credit score down. So it impacts your credit score. So just be careful if you're doing that. And so now that you're in this class and you know this information, so I know you're not going to be doing that. So, all right, knowledge is power, right? All right, so those are inquiries. So before we go to the credit score, any other questions, observations? Yeah, so the question is, why does it pull your credit score down if you go to a dealership, if you want to buy a car and you go to multiple dealerships? Because, well, banks don't know if you actually got credit at all those places or not. So there's a lag time between the time that you purchase a car and you make your first payment. And so, again, the financial institutions, we report based on a monthly basis based on the payments that you make. So the potential for credit at all 3 of those locations is there, and so banks want to just acknowledge that. So that's a reason why it pulls your score down. Yeah, even though you only got 1 car loan, you could have gotten 3 if your FICO scores and everything is right.
The potential is there.
Right.
So you're not technically supposed to see what that potential is?
No, because again, there's lag time there. So banks simply don't know if you purchase 1 car or 3. Yeah, we just don't know. So it's a way of getting the bank's attention to say, okay, pay attention to this because, you know, this person could have gotten one car, could have gotten 2 cars, could have gotten 3 cars. Yeah. Question?
Is there a time limit, like on how long it takes for your credit to build back up after they do a hard like pull your credit like that? I mean, let's say you're still making all your same payments on time and everything
Right.
like that. You know you're gonna lose some points, but is there? Because it says many months. By many months, your points will go down. Is there a time limit on how fast it takes to get your points back up if you're still making all the same payments and stuff on time?
No, because there's not a timeline. So the question is there a timeline for your credit score to build back up once those hard pulls have been made? There is no timeline. It depends on your overall credit history and your credit record. How often you make timely payments. I mean, there are that's one factor of many that goes into your credit score. So there's really not a time frame for it. But if you're, again, monthly reporting by finance companies and credit card companies and banks and credit unions will be on a monthly basis. So you should see it start to increase on a monthly basis, but the time frame, it kind of varies. Yeah, could be 3 months, could be 5 months, could be 6 months or 9 months. Yeah. It just depends. Everybody's different. Yep. Question?
When your house or
She's coming to you. I know, right? We want to make sure everybody hears you.
when you're house or car shopping, what's the window for shopping around for those hard pulls, hard credit pulls?
So what's the window for shopping around?
You're gonna have it
for the
pulled
hard
more than one
pulls.
time.
Yeah, so I would try to make sure that you only pull credit when you're sure that you're ready to purchase. So the moment, and you have to authorize these credit card or these finance companies to actually pull your credit, or it could be a mortgage company, it could be a bank, a credit union, but you have to physically sign and authorize them to pull it. So, okay, maybe I'm misunderstanding your question.
For your credit to be affected, and you're shopping around for the best loan, and different banks you may be a member of several different banks and credit unions.
Okay.
And you go to each of them for the same loan offer that you're wanting.
Okay.
How does it or does not affect you in having 4 different credit union banking systems pulling your credit?
Yeah. So again, if you're shopping around, that's one thing. If you're inquiring about, what's the interest rate, what's the time frame that Arvis Bank would make a loan on a car, then you go to a credit union and ask the same question: what's your current rates? How long will you finance it? What's my monthly payment? You can make those inquiries without actually authorizing them to pull your credit. Yeah. So I would recommend that you not authorize them to pull your credit if you're just simply inquiring about the services. And I would just make that clear that I'm not quite ready to pull the trigger just yet, so to speak, and make a purchase. I just want to compare the different banks, different interest rates, different terms, and there's nothing wrong with that. Banks do that all the time. So, yeah. But I would be slow to authorize the credit pool until I know that, okay, this bank has the best offer for me in my situation, and then that's when I would actually make the application and authorize the credit pool. Yeah. Question?
You know how many points a hard inquiry will pull your credit score down by?
No, I don't, and that's always a question. There's a formula that I can give you, but the credit bureaus control the credit scores, the files, and all that. We can give you some clues and some hints that's going to help you, but we can't give you like a verbatim,
Is
like
it
a hard pull to pull it down.
range, kind of?
No, because again, it varies. Really, it depends on how much credit you have, how many different types of credit that you have, whether it's car, mortgage, credit card, and if you have multiple of those, everybody's different. Yeah, it's just hard hard to pinpoint a number on it or range. Yeah.
Thank you.
I know I'm not quite answering your question, but there's no definitive answer to your question. Yeah.
I understand.
Yeah. Good question though.
It's at the bottom, if that's like, right?
I'm sorry.
Is that what he's asking, that last, the last sentence? the
Yeah.
20?
Yeah. It's that's not. It's not a science. So it could be 25 points. Or it could be 4 points. I don't know that that is still the case. Probably should take that out of our presentation. Yeah. Good call out. Yes.
Try, sorry.
No. Glad you're reading. That's what we're here for. Yeah. Other questions?
Is it like one person in charge of your score? Is it a computerized system?
So it's a company, and so I'm sure there are metrics and computers and that helps compile all the data because again it's every consumer in the U.S. and so I'm sure it's not just a person. I've never really had that question, so I don't know. Kind of going behind the scenes of a credit card or of a credit bureau. But I'm sure it's not just one person, probably multiple. It's probably a whole department. And I'm sure that there's some analytics that are involved as well. Yeah. Y'all hit me with some great questions. So that's good. Other questions? Okay, we'll move on to the meat of the presentation. So when you walked in, so you were handed a handout because it's really important when you look at the credit score. So we'll go through the credit scores first and talk about kind of what's good. I already kind of hinted that a credit score that's 800 plus is super good. We call it exceptional. You're well above the average score for most U.S. consumers. So if you got a credit score of 800 plus, keep doing what you're doing. Keep doing what you're doing. That means you're paying your bills on time, you have a good credit mix, you don't have too much debt, and you're not utilizing all of your available credit, which is good. That means that you're a good credit risk. Okay, so if you have a credit score between 740 and 799, still very good. It's above the average. So that indicates that you're a responsible borrower, you're dependable, you make your payments on time. The bank's not going to have to chase you around and try to, pull the payment out of your back pocket. Just kidding, banks don't do that, by the way. But still a really good score. So 679 to 739, still good. Not as good as 850, not as good as 799, not as good as 750, but still a good score. It's slightly above the average to a slightly above if you have a 670 or 739, so still a good score. And then you move to 580 to 669, so you're starting to move to below the average. A lot of banks have a cutoff of credit scores. Ours happens to be 640, so anything 640 or less gets a little bit more scrutiny. Now, you might still be able to get a loan at 640, so don't get me wrong, but your interest rate will be higher. So you'll be paying a higher rate of interest just because your score is a little bit lower, which indicates that you might be a little bit greater risk. And so that's what banks do. We evaluate risk. So the risk of you repaying us, the risk of you not repaying us. So when you have a credit score that's below the minimum, doesn't mean that that's necessarily bad all the time. But then when you get down into the high fives, we got a little bit of work to do. Yep, got a little bit of work to do. It's not the end of the world, but we just have a little bit of work to do. And bless you. And typically that means doing some things like making sure that we're making payments on time, maybe setting up auto debits to make sure, maybe paying early, getting in the habit of paying a little bit early if you don't have the auto debit. But there are some things that we can start to do from this point forward that will help improve your credit score. So we can also write letters to the credit bureau if there's some information that's derogatory on your credit report that's been there for a while. We can write letters to the credit bureau and have them investigated and take those things off if enough time has passed. So that's a way to improve your credit score as well. So there's some things to do to help get the credit score up, because again, we want you to have a credit score that's 800 plus by the time you leave this class and know exactly how to get there. So it starts with just knowing what the ranges are of the credit scores and whether they're good or bad. So any questions about that? All right, no questions. Question? Yes, sir.
What credit score do you start off with if you have no credit at all?
You know, I've seen it in the high fives. I've seen it in the sixes. You know, if you have no credit record, if you've never borrowed money before, then you don't have a credit score at all. And so you have to start somewhere. And so we recommend that maybe you start by, you know, getting a credit card that has a small balance on or small availability on it, and it might have $1,000 available, and you draw it. Bless you. And you draw it up to $500, and you pay it back, and you do that every month and pay it back and pay it back, and so you might want to start there. But I've seen them. It varies. I've seen, you know, again, 600s. I've seen 5s. I've seen 7s. It just depends on what that first credit is. If you buy a car, for example, you know, I've seen situations where new borrowers, parents have co-signed, or someone has co-signed for a borrower, and that helps to jumpstart their credit history. So, yeah. Other questions? I know you guys aren't bashful. How's the family doing? Family good? Okay, I have to check every now and then just to make sure, like, you know, talk back to me. I mean, I'm not Candace. I get it. She's a whole lot more, you know, funnier than I am. No. All right, so let's talk about what it impacts the score. So before I leave the screen, though, notice, forget about the 10s, the 10%. So that's 20%, right? So if you think about your credit score at 100%, there are 3 things on here that make up 80% of your credit score. So if you do these 3 things well, your credit score will improve. So when I was in college, you know, the instructor would always like hit the desk or, you know, stomp his foot or do something to say, let that sink in. So 80% of your credit score are these 3 things: the payment history, good payments, the length of credit history, and then also the amounts owed. So if you can manage those 3 things, your credit score should improve. Your credit score should improve. Your credit score should improve. Those 3 things: amounts owed, payment history, and the length of credit history. All right? So let's talk about what impacts. We'll come back to that. You'll hear me say that over and over again because I really want that to sink in. 80% of your credit score is made up of these 3 things. Okay, so what impacts your credit score in a positive way? So we talked about a little bit about this, but credit utilization. So if you have a credit card that has a $5,000 balance, the recommendation is that you draw that up to $1,500 maybe, and then you pay it back. Never use the full availability because that helps your credit score. Because what that does, it says or it demonstrates that you're responsible with the credit that you've been issued. Okay? I know it sounds weird, but if you have a $5,000 credit card, you know, in my younger days, I want to charge up to the $5,000, right? Because that just makes sense. That's, after all, they gave me that credit, right? So I need to utilize it fully. Well, no. So it's counterintuitive. So 20 to 30% utilization of that credit card, okay? So don't use the full availability. So it demonstrates that you are responsible, you can handle the credit, and that positively impacts your credit score. Okay? Yes, question? Can we get a microphone, please?
We're talking about payments. So I've always been told, like, it's best when you get a credit card, pay the balance off at the end of the month.
Right. That helps too.
But that's kind of hard sometimes when you don't have it to pay off.
Yes. Yes.
So then that's probably what makes your credit go down.
It does. It does. Yeah, it does. So, yes, after all, you applied for the credit because you needed it, right? Or at least you wanted it. You thought you needed it, right? So, yes, it's good to pay it off every month if you can. If you can't, then if you can figure out a way to make some type of lump sum payments, but definitely make sure you pay on time. And my definition of on time is on or before the due date. Okay? Good question. Yeah. Thank you. No, appreciate it. Help me out there. Okay, so 2 or 3 lines of credit. So you want to have like a mortgage, an automobile, a credit card, maybe even a home equity loan. So the more trade lines that you have, the better, as long as it's not too many, where you overextend yourself. There's kind of a fine line because your credit score is one factor that banks consider when they evaluate whether or not to make your loan. The other factor is your ability to repay the debt, which is a whole nother story. But so don't have too many. That's the point. Again, on-time payments, making sure that you're paying on time, don't use too much credit. Long-standing credit history, again, back to your question about whether you close the account when you pay it off. If you do, that's gonna hurt you. So try not to pay it off. And again, when you have that history of paid off loans, that's going to help you because you start to build a positive credit file. Hopefully that loan that you paid off, those payments were made on time. I'm assuming those payments made on time. Now, if it's a credit card that you've had some issues with and life happens sometimes and you just can't make payments on time. So if it's a credit card that maybe you're not proud of the history, then you might want to close that credit card out and then get another credit card and start developing some new history of on time and timely payments. So that helps you down the road. Yes, sir. Question. Wait for the microphone if you don't mind, sir. Thank you. All right.
Is it such thing as a goodwill letter? I think basically what I read before is if you're late on a payment, and let's say for instance it was extraneous circumstances that the business that you're late to, you can write them a letter for them to write a letter about excusing their late payment off your credit history if they reported it once before. Is that true?
So I've never heard of that. So it's always a good idea to communicate with your bank. If you know that you're going to be late, it's always a good idea. But keep in mind, creditors, they report on a monthly basis. So they have to report the accuracy of the payment, whether it's paid on time or not. I think that letter goes a long way when you're trying to maybe restructure some debt. But in terms of helping your credit score, I'm not sure that the letter's going to help that. Yeah. Not a bad idea, but it's just not, typically banks are not going to accept that to such a level that it impacts your credit score. Yeah. Other questions? Okay. Yes, maybe so. Thinking about it? Okay, I knew somebody had a question.
On your, like when you say 2 to 3 lines of credit, and you're saying like your mortgage, your car note, things like that. Well, like I don't have a house, I rent, but at one point in time they weren't checking like your credit whenever you were applying for an apartment. They just check your renter's history. At one point, did they start running your credit to approve you for an apartment, and why wouldn't that apply as the same thing as mortgage. Obviously, I mean, I'm not borrowing the money to pay my rent because it's coming out of pocket, but shouldn't it count because they're gonna run your credit?
It does, but it also gives them an indication of how responsible you are with your debt. And so even though you're applying for, say, insurance or to rent an apartment, it's still a monthly obligation that's going to be incurred. And so one of the things that they're looking for is how you paid your other monthly obligations. And so they use it to kind of gauge how you're going to pay or get an indication of how you might pay in the future.
So they do look at how you pay your. Oh, I'm asking. They look at how you pay your rent since they check it when you apply.
So rent, no.
Right.
No.
So why do they check it? Why do they check that whenever you're applying for an apartment if they didn't do it in the past? Is what
Yeah,
I'm
so
asking.
just to get a general feel of what your credit history has been. So how responsible you've been with credit overall.
Yeah.
And so when we talk about 2 or 3 lines of credit, let me clarify that typically that's the payment line. So if you notice on one of the screens, if I go back here, there were multiple lines. Yeah. So 2016, 17, and 18. So when we talk about multiple lines, that's what this is referring to.
It's not really a question. It's more to go off of what he said. My apartment, you can pay a service, and they will track when you make your payments
Okay.
for your rent. So I would ask your apartment if they do that.
Okay. And that may be something new. So yeah. Do they report to the credit bureau?
When I pay my rent, it tracks it, and then I think it's through Credit Karma. I can pay a certain amount, and like any utilities that I am paying or my apartment, it tracks all of that and pushes it towards my credit score.
Okay. I've not heard that before, so that's good. Yeah. Had you heard that before, Dee? I hadn't.
Some kind of credit boost program.
Okay. That's good.
Mine is not a question. It's piggybacking off of both of those. Make sure, because it is a fee. It is a fee that they do charge you for, but it does help to improve your credit. I did it the first, because I rent as well. I did it the first 3 years. I rented my apartment, and it improved my credit.
Okay.
Well, I didn't know. Honestly, I didn't know I was on it, but the first year I didn't know I was on it. But
Gotcha.
the second year and the third year, I started monitoring my credit, and it does help for those who maybe have like a lower credit score or maybe are trying to work on improving it.
That's good. So any way that you can help boost your credit score, I mean, that's a great option. I just not heard of that before, but yeah, that's a great option. Tia, one question again. But yeah, that's a great option if your apartment would do that.
So for buying a house, is there a difference between a business loan for buying a house, like such as flipping a house, and your regular mortgage? And is that a different credit limit, like such as your utilization of your credit?
So the question was, is there a difference between buying a home under the business name and as opposed to a personal name?
Yes.
And so typically, if you're buying and flipping houses, that's a business loan. There are some differences with the qualification and things that you have to present to the bank as opposed to a mortgage loan. You fill out the application, pretty much a W-2, and they qualify you based on your debt to income. But when you have a business, there's a lot more that goes into it. If you are a small business, your credit score definitely is a factor. Because when you're a small business owner, typically you are the business and the business is you. I mean, you're not like a large corporation. And so we underwrite the individual and the business, typically in that situation. So we still look at the credit scores, the individual credit scores, but a little bit more emphasis is placed on the underwriting of the business. And we flip it and call it the cash flow coverage ratio instead of a debt to income ratio. The same thing is just calculated a little bit differently on the business side. So there's more information that's required. Typically, we're going to want to take a look at your tax returns for 3 years. You're going to need to complete a personal financial statement. Whereas on a mortgage loan, you don't have to present those things. Typically, it's W-2s and things like that. It's pretty quick.
Okay,
Yeah.
and the other half of my question, would that be the same 20? Would that be the same 20 to 30% utilization on the credit rule?
Yes. But it's less. Oh, sorry. It's less reliance on your personal score when you're applying for a business loan, even though we look at it. But we can also mitigate some things if you own a business, if you've had some issues on the personal side.
Okay, thank you.
Yeah, you bet. I think I did. If there's a way to break it, you know I will. It's coming back up here. Other questions in the meantime?
I have a question. It's kind of on the other end of his initial question about if you don't have credit history. My sister and I kind of had a different experience. When we went to start building our credit history, we found out one of our parents was already using our credit. And like my sister had a loan in her name when she was 5. And so that she's still responsible for it. And my question is, why, in the face of those blatant those facts, why would the credit bureau still require someone to pay that when you can, and it's obvious that someone else did that in their name? Because I had a couple in mind, and I was like, I was in elementary. I guess they weren't as tight back in the 90s and 80s.
Right.
And so, like I said, we had stuff in our, I didn't know until I went to the bank to refinance my car. It was been my very first time, and I found out I had
Yeah.
so much debt.
Yeah, that's a.
So is there
That's-
nothing you can do other than pay it back or take responsibility for it?
That is a deeper question that requires probably some type of
Because you don't want to turn your parent
consulting.
in,
Right,
but it's like,
right.
you know?
That could.
When I found out I was like 17, 18.
Yeah.
Like, so it's been, I'm 37 now, but it's like, geez, Lo, please.
That can
don't.
be a little tricky because we love our parents but yeah, that's a deep question that we probably. Okay, thank you, David. David has an answer. The attorney in the room has an answer.
So with the credit bureaus, you actually are able to dispute things that are on your credit that don't belong on your credit. Like a situation where clearly you were a minor, you couldn't have established that line of credit. You can send a dispute letter to the credit bureau, and the creditor then has an opportunity to respond. Either they don't respond or the response is inadequate in some way, then it comes off. But there is, on the session that I do later, there are a number of free forms that are on one of those slides, and one of those is a credit bureau dispute letter.
Yeah. Yeah. Thank you, David. Yeah.
That doesn't mean you're turning your parents in and saying, she did it or he did it. Just tell them it's not you. Right. Your identity was stolen young. You don't know who did it. You get my point? Yeah. Okay. Because I ain't saying attorney folks in. Right. We ain't gonna say that.
Yeah, there are some situations that we probably need to take offline, and that's probably one of them. Yes, good question though. So you're in the right place. Oh, okay. We're gonna move on just a little bit, and then again, I'll try to catch any questions as we move on. So who can review your credit report? Creditors. We talked about banks, credit unions, lenders, car dealerships, credit card companies, employers. So if you apply for a job, they can check your credit. For example, if you apply for work at a bank, they want to make sure that you can handle your personal affairs if you're going to be working with money. Kind of makes sense. So they'll check your credit score just to make sure that there's nothing there that's concerning. And you, So I mentioned that annualcreditreport.com is a website that you all can go to. It's free, and pull a copy of your credit report and take a look at it. Okay? So establishing credit, we talked a little bit about this. We delved a little bit into it. So, you know, it takes a little bit of time, a little bit of work. Establishing credit or reestablishing credit is another option that we'll talk about here in just a little bit. But again, when you don't pay off the balance until you get your statement, because you want that full cycle, 30, 31-day cycle to pass, so that you can have that. You're not timing it, but companies report about every 30 days, so monthly. And so, again, there's some benefit to you getting that statement and then paying the full balance off. In some cases, co-borrowers may be required. Talked a little bit about that. Want to pause for just a second and just say that if you are ever a co-borrower, understand what that means. You are a co-borrower. So that means if the primary borrower does not pay, you are obligated fully to pay. I'm not.
See, that was one of the issues I had. I was a co-borrower in elementary,
Mm-hmm.
on top of different, so like, is that?
Yeah, there's a difference in your case, yeah.
Okay.
Yes, so,
Kind of left.
same kind of letter, yeah. But if you're of adult age and you co-borrow, then just know that you're just as obligated to pay that debt as the primary borrower. And here's the other kicker. How the primary borrower pays impacts your credit score. So if you have a primary borrower who does not pay, it's going to impact your credit score. Absolutely. Yeah. Questions? Tina? Normally, I would say be very careful about being a co-borrower. I'm not going to say don't do it. I'll stop short of saying don't do it. There are occasions when it does work, but just be very, very careful. Question.
Okay, so I don't have kids, but for people who have kids and they are trying to maybe teach their kids about credit and they don't want to do the option of adding them on there as a primary borrower, would you suggest them doing something like a prepaid credit card, or what would you suggest for them?
Yes.
To kind
So
of build their line of credit in maybe a healthier way or something like that.
yes. So there are ways to build your credit or build new credit in the case where you may not have any credit. And so some banks offer a secured credit card. So basically what that means, you put up $1,000, they'll give you a $1,000 credit card. And so it's completely secured. It's low risk to the bank. It helps the new person establish credit. That's an option. Maybe the best option. Again, co-signing is an option. Just be very, very careful and understand that you've got to really get into the primary borrower's business, so to speak, because you need to make sure that they're paying timely. And sometimes that can be a little tricky and a little sticky, but those are two good options. Other questions? Question back in the back?
My daughter, she's 18, and I tried to pull her credit to see what her credit score is actually at before I begin to help her build her credit, like I did my oldest, and I could not find her.
So she doesn't have any credit? Yeah.
Is that what, because I did my oldest like that, and I was able to pull her credit, and she actually had.
Did she have some type of credit card, or when you say age, are they college age, are they high school age? Yeah.
Well, the 18-year-old just recently graduated, and the 20-year-old, she has card history.
Thank you. Yeah, the reason I ask is when I was a freshman in college, they were pushing credit cards. As a matter of fact, they gave you a free T-shirt if you applied for a credit card. And so what Could it have been that she maybe had something that you were not aware of?
Oh, no, she has, I co-signed for her car, my oldest.
Okay.
But my youngest one, I can't even, like, get a student credit card for her. I've tried everything, and I just gave up. Because I don't know what else to do to try to help her start building her credit.
Yeah, probably need to probably talk about that a little bit. It's maybe something special going on there. It sounds like it. I think my battery's going down on my laptop. That's why it keeps going off. But we're almost at the end. Were you finished with? Okay.
I'm good at piggybacking off of others, but similar to what she's asking, when my kids were like their senior year of high school, 11th grade-ish, I added them to my lowest credit card as an account holder. And I did the lowest, and you can see this, because I was still thinking about debt to income ratio when they do get to a point, but they could still be building credit, just as an idea.
Yeah, that's a good strategy. Yeah, absolutely.
Make sure it is called an authorized user, right? There you go.
Yep. Other questions while I reboot my laptop for the third time? All right, let's talk about types of credit. So until my screen comes back on here. So there's installment credit and revolving credit. So it's in, again, you guys don't have the handout, but online they probably do. So I'll just talk through it. So basically, installment credit are those loans like car loans, boat loans, RVs, mortgage loans, anything that you pay on a installment basis. And then if you have a monthly payment where every month you have a payment that's due, that's an installment loan, typically for cars, boats, motorcycles, that type of thing, home equity loans. And then revolving credit are lines of credit where you have a balance. Let's just say it's $5,000, and you draw it up to $4,000. You pay it down. As you pay the balance down, the amount becomes available to you to use over and over again. So it's hence the revolving name there. But it's flexibility. You don't have to reapply for a loan every time on the revolving loan. Like if it's an installment loan, it's a term loan, and as you make payments, the balance decreases, but you cannot charge it back up without applying for new credit. On the revolving loan, then you have the option to charge it back up without having to reapproach the bank and reapply for another loan.
So while you do that, can I give them an example?
Absolutely.
Okay, so let's say you have a line of credit. Y'all know what a line of credit is? Okay. So line of credit says, hey, I have $10,000 I can use on that line. I'm gonna spend $2,000 of it. But then, that means I have $8,000 left, yes? Okay. Once I use that $8,000, what he's saying is that, okay, I'm sorry, I used the $2,000, I paid it down, now I got another $10 to use, it's available to use again. But if it's an installment, that means I'm gonna pay it when it's gone, that's that. But the revolving consistently revolves and I can keep using it over and over. That's what he's saying.
Yeah.
We good? Boy, they got
Almost.
you all in there.
I know.
So it's considered a car?
So a car would be more of an installment account. If it's a $20,000 car, I'm paying it down, and when I pay it, it's over with, right? But that's not revolving. Revolving means I pay it down, I can spend it again, pay it down, I can spend it again. That's right, but that's not a car though, right? Okay, we got it. Installment versus revolving. There you go. You got it. There was a question online.
Okay. Yeah, it's off,
Right there.
offline.
You good?
Mhm.
You are good?
No, it's offline. We'll,
I got
we'll,
you.
we'll
I'll
just
fix
keep,
this.
keep on. Mhm.
Oh, there was a question on
Yes.
Rondo.
Mhm.
Okay.
She said, the question was, how do I make principal payments? What's the difference between a principal payment being made to my loan versus the principal and interest payment?
Regular payment. Yeah, so there's a regular payment that when you apply for a loan, they will set your monthly payment that includes a principal payment plus interest. We call that a regular payment. But you also have the option to make a irregular payment or a principal-only payment. And all you have to do is notify the bank or the financial institution or the credit union that you're making a principal payment and you want all of the proceeds from that payment to pay down the balance, the principal balance. And so the benefit of doing that is you pay interest based on the outstanding balance. So when you pay the balance down over time, you end up paying less interest over time. And so that's why a lot of customers do that, and a lot of customers will make that principal payment because it does a couple of things. It reduces the amount of interest that you pay over time, but it also causes you or helps you pay off your loan quicker. Yeah. Okay.
One of the things we'll go over in the debt plan, we'll actually talk about and show you what it looks like to add literally like $100 to your debt plan and have everything paid off within a 10-year span. So it's gonna be really good right after we eat. All right, we in there, Marcus.
Oops, sorry.
That's all right.
We were in there. Till I hit the wrong button.
You're fine, you're fine.
Other questions while we're? That should be it. Yeah, I think it's popping up here. Yeah. Okay, so there's also a thing called a home equity line of credit. And basically, it's a line of credit that's tied to your home or tied to the available equity in your home. So if you've been in your home for a while and you don't, or you want to get a loan that provides you flexibility, you might want to make some repairs, you might want to remodel your kitchen, you might want to buy some new appliances. Thank you. And so this is an option. It could serve as a safety net, but it's a really flexible loan. So again, the revolving loan is flexible because you don't have to reapply every time you want to use the proceeds. So that's a good option as well. Slide back a little bit here. We talk about the revolving credit, the installment credit, debt paid monthly. All right. And I'm really over my time. So basically, if you want, because fraud right now is rampant, I encourage everyone to have some type of credit monitoring on their credit report. You talked about it, classic case. You don't want anybody stealing your identity. You can freeze your credit report so that you actually have to grant permission for someone to actually pull your credit report. So that helps with the fraud piece of it, gives you security, peace of mind, all of that good stuff. So I highly recommend it. So we made it through, despite the technical glitches. All right, questions? So 800 credit score plus is where we're headed. All right, and you guys have a handout that tells you how to get there. We talked about 80% of your credit score, what makes it up. I think we've got maybe we have a gift card for somebody who can tell me real quickly what makes up 80% of your credit score. Quick. Okay, we got a hand right here.
The one thing I wrote down. No.
Okay.
The payment history, the length of the payment history, and then the amount that's owed.
Yes, okay. How about that? Good deal for you. Okay, guys, that's my time. I'll hang around afterwards, but we need to break and eat, and then we'll come back and start another session. But if you have questions, I'm happy to visit at break time or afterwards. My contact information is also here, so if you have questions after we leave this evening, I can be reached at this number, 379-7238. All right. Because you guys attend this class, you get free access to me. So it's almost like you have a personal banker. All right? All right. Thank you, guys. Want to go ahead and, okay. Let's go ahead and bless the food real quickly. Lord, we thank you again for another opportunity just to say thank you. We thank you for everything. Lord, we just can't thank you enough. We ask that you bless this food for the nourishment of our bodies. In Christ's name, amen. All right.
Tonight is from Sweet Papa's. You know, we always end with a bang. It's gonna be real good. We got smoked chicken, green beans, mashed potatoes, gravy, fruit, and cookies and a drink. And don't get two of the sauces. Only a couple of more. Y'all share, okay?
All right. Don't be bashful. Come on up. Come on down.
Grammarly helps me get the best grades possible while depleting the least amount of hours of my week. I'm Lauren Taylor. I'm a student and future CMO, and I am a Grammarly user. I first got Grammarly to help me with my college application essays, but now it's kind of cool because it's evolved as a platform. Grammarly's AI Compose can help me narrow down what to write about. I can, in 15, 20 minutes, have a decent outline of what I'm going to be writing over the
want to use my voice for things that matter, like menopause. Women deserve to know that there are treatment options for moderate to severe hot flashes, like Linquet.
Linquet is a hormone-free treatment for moderate to severe hot flashes due to menopause. It reduces the number and severity of hot flashes day and night, with some women having fewer hot flashes as early as 1 week.
So, enjoy the celebrations, own the room, and be in the moment with fewer hot flashes.
Don't use Linquet if you're pregnant, as it can cause loss of pregnancy. Tell your doctor if you have liver problems, a history of seizures, are pregnant or planning to become pregnant. It can cause serious side effects like central nervous system effects and daytime impairment, like difficulty staying awake, fatigue, a spinning feeling, dizziness, or feeling faint. Don't drive or do hazardous activities until they pass. Increased liver blood test values may occur. Your doctor will check them before and during treatment. There's a risk of seizures in people with a history of seizures. Seek medical help for loss of consciousness or seizure. Most common side effects include headache, fatigue, dizziness, and sleepiness. These aren't all the possible side effects.
Our lives don't stop for hot flashes, so don't let hot flashes stop you. For moderate to severe hot flashes,
Here we go. So this is Josh. He said, I'm on Candace. I'm going to do it in 3 years, and I'm gonna cut the gas station out a little bit because I could save $3.33 a day, right? We do that easy. And get you some of that shh. All right. Here we go. Now we got a plan. We put all the information in. We're going to start with $100 because anybody can find $100 no matter what. Y'all agree with that? Y'all agree with that? Somebody said for the most part. I heard you. For the most part. Find 100, okay? Not 100, find 100. Okay, we can find it. Okay. In the calculator, when I put in this information, it said this person can be debt-free in 10 years and 8 months. 10 years, y'all? We talking about the mortgage and everything? How much did we say they spending monthly extra? How much? $100. So you telling me, Candace, if I take all $383,000 worth of debt, I can pay it off in 10 years? Yeah. You committed? Yeah. Let's do it. Ooh, y'all got quiet on me like y'all didn't believe me. Y'all got quiet like you didn't believe me. Okay. You know what's funny? Let me tell you something. The more debt you have, the faster you get out of debt. Well, you know how money works. That's how it works. The more debt you have, the faster you can get out of debt. The less you have, the harder it is. I'll explain later. I'll talk to you about it later. I ain't got time today. So it says 10 years, 8 months by making those fixed payments of an extra $100. The money that the money they were already spending plus $100. Plus how much? $100. And what is $100 per day? Here we go. We in there. All right, let's talk about what it looks like. So on the calculator, I want to make sure you're reading it properly. I kind of feng shuied it just a little bit. It's not super hard to see, but if you did yours, you'll know where I'm at. But if you hadn't done it, this is what it's going to come up. It's going to give you a document and all these words. But here's the chart. On the chart, it says pay credit card number 2 first. Then it says pay. It tells you at the end right here. It tells you exactly what to do. Pay $190 for 17 months. Hold up. At the end of it, it's going to give you like $8 or some change. No problem. This is what I want you to understand. The $190, the original credit card payment was number, credit card 2, number 4, was $90 a month. So they just added the $100 to the 90. Now we're going to pay $190 instead of 90. What are you going to do with the other debts? Pay the minimums. Exactly. So if you notice, it says pay on the next one. I'm just going to show you the example. On the next one, it says pay $170 until month 17. That's the same payment that was already there. It was $170 on credit card 3. You're going to make the same payment. Why? Because you still want to keep your credit score good. I'm only attacking one debt at a time. How many debts at a time? So I'm not going to take that $100 and say, I'm going to put 50 over here and 50 over there. No. I'm going to attack the one debt. I'm going to add the extra 100 to that, preferably to the principal. Okay? I'm going to pay the minimum of the 100 and add the 90 as the minimum and the extra 100 to the principal. I'm going to say it again because I don't want you to miss it. I'm going to pay the regular $90, and I'm going to add the extra 100 to the what? Got it. And then I'm going to pay the minimum on everything else, yes? It tells you to do that in the plan. Now, when you keep going, the same information is popping up because for those periods until it's time to attack that debt, you're still paying the minimum. Your key is not to run it up. Woo! You hear me? Hello? The key is not to run it up. You got to stay disciplined. Hey, I'm not spending all my money on these cards. I'm done. If I ain't got the money, I ain't spending it. Yes, ma'am. Got a question at the back? Got a mic? It's okay. Just say it out loud. I'll repeat it for you. Well, this is the thing. If it's a zero balance and you don't use it, it's not good. But they don't mind if you got money on it and you just letting it, you paying your minimum. That's what they want you to do. That make sense? So, because they making money off of you. So use this plan, promise. What she's referring to, she said, I thought that I'm not supposed to not use the cards. If you paid it to zero and not use it, they're going to say, you're wasting my credit line, get out of here. That's what they're saying. Because they want to make money off of your money, off of you, right? So her strategy is right, but if you got a balance owed, pay the minimum. Do the strategy. Okay, we together. Here we go. I'm going to show you in just a minute. Does this make sense? Keep the plan all the way down, pay the minimums, attack one debt at a time. How many debts at a time? One. How much extra money are we using right now? $100. How much is $100 every day in a month? $3.33. Can we save $3.33 a day? Can we save it? Yes. For real? Yes. Come on, man. Like, this sounds so simple. It really is. But you know what you got to do first? Your plan. So you can know. If you can see it for yourself, it's better for you to be able to go through the process because you got a vision for the process. Okay? Here we go. My debt plan is my retirement plan. Last week, a young lady asked, Candace, I don't even know what it looks like to retire. Can you tell me about that? Because I can't even imagine it. If I can pay my debt off, I can imagine not working. At least not as hard as what I'm working now, right? So I want you to take a look at Jenny. Jenny is 55 years old. Because we talk about this concept called invest in your debt. Investing in your debt gives you the highest rate of return that you could ever get. But let's look at it so you can really understand it. We talk about it. Deacon Thomas goes through it, and he said, you should do this. And everybody just looks at him. And today we got an example. You 55. Anybody 55? Yeah. Keep living. That's what my grandma say. Old is the goal. Oh, 55 ain't old. That ain't what I meant. That ain't what I meant. I just want to make sure y'all paying attention, man. Come on. Come on now. Y'all. I did. Listen, I'm trying to get there. Come on. Okay. Here we go. Jenny, 55. She has $5,500 in retirement income every month. This is an example. Here we go. Her debt. Well, it don't matter if you got $5,000 if you're spending $6,000. Okay, here we go. They was like, ooh, that's good. Here we go. Now, and I ain't breaking this down like, oh, she got Social Security and this and that. We ain't doing that. I just need you to understand the concept of investing in your debt. Here we go. She got $5,500 monthly. She got debt of $3,050. And then she got monthly expenses of $2,020. Y'all like, what? The debt and the monthly are separate? Yeah. She doing stuff. I don't know, right? Huh? At 55, she hanging out. Okay. If she pays out, y'all laughing at me. This is real life. Now get your calculator out because I ain't got a lot of time, but I need y'all to help me. 4:30. Boy, I told y'all something. I'm excited. Okay. If she pay off $3,050 in debt, how much is her cash flow? Hello? Y'all looking at me. What you got? If she pay off $3,050 in debt, how much is her cash flow? Let me ask you the first question. Wait, the question that's not up there. What is her cash flow now? Income minus expenses equals cash flow. Okay? Because somebody was like, what's cash flow now? So you got to go back.
You got to add up the debt and the monthly, and then subtract it minus the $550 to tell you what the cash flow is. What's the cash flow? $430. So right now in her life, she has $430. We together? Extra at the end of the month if she don't do nothing extra. Got it. Cash flow, we got that. So we saying if she pay off the debt, she got how much? $2,450 in monthly cash flow. Now somebody said, she said she got to get rid of that debt because that's life right there. But this is the thing. Some of us look at those numbers like, oh, those are big numbers, or if I don't make that kind of money. That ain't what the example is for. The example is so that you can see if I pay my debt off, that is my retirement plan. That is the greatest investment I can make is into my debt. It's 1,000% rate of return. It's actually no risk. How is it no risk? You already done spent the money on the stuff. Now pay it off. Be diligent. Discipline. Let's do it. Do we understand this? If you're in a season, what we call your season of, hey, it's time for me to kind of calm down, retire a little bit. I don't want to work as hard. If you want more money, pay your debt off. We got it? It's pretty simple. Okay, here we go. Invest in your debt. It's the greatest investment you can make. All right, I got to move quickly. Retirement is not an age, it's a number. Retirement is not an age, it's a number. It's based on how much money you have to where you can sit down somewhere and not go to work, where money is either still coming or I'm not required to have as much. Does this make sense? Retirement is not an age, it's a number. We agree with that? But the important part is that I must invest in myself at the level at which I expect results. You come to class, you invested in yourself. I expect results from my investment in me. But if I invest a little bit, I'm going to get what? A little bit? But if I invest a lot of it, okay, you know, how we want to look at it. So I must invest in myself at the level at which I expect results. Can we say that together? If you online, y'all sounded okay, but we're going to count it off in a second, okay? All right, y'all got it out your system. You had something in your mouth. It's okay. If you online, type this online, because if you type it and say it out loud, it reinforces in your system and your soul. Get all in there. Come on, let's do it again. Y'all ready? 1, 2, 3. Do you mean it? Because y'all said it real slow. Like, say it like you mean it. Like, say it with your chest. You ready? One more time, because you done ate, y'all got sleepy. Y'all, you stand up? I didn't eat, this is why, because y'all like, ooh, I'm ready to go to bed. I'm just playing, man. That chicken was good, though. I know it was. It was good. Okay, one more time, so now I'm going to go. Y'all ready? Go. That was so much better. I love it. We ain't taking no breaks. I got to do this, okay? Here we go. You know, initially I was like, take a break. No, we ain't got no breaks. We skipped that one. Okay, here we go. Well, I'm glad y'all with me. Y'all woke up after that one. Here we go. What a mess. What if I don't do it? Now, some of you have seen this before. Some of you hadn't. I want you to really understand this concept. On your piece of paper, there's this thing called the Rule of 72. It's the banker's secret. We consider it to be how your money grows. Anybody know the formula? Not you, Sabrina. I know you know the formula. Anybody know the formula? Okay. That means I get to teach you something. Ooh, and I got time today. Let's go. Here we go. The banker's secret says the Rule of 72. If you take the number 72 and divide it by your interest rate, it tells you how many years it takes for your money to double. Uh-oh. Okay? I'm going to say it again. Take the number 72, divide it by your interest rate, and it tells you how many years it takes your money to double. It's the Rule of 72. We talked deeply about this in the segment 3, where we do the retirement plan and stuff like that. Oh, we got some wonderful stuff for y'all coming up. But I got to give you this because you got to understand the opposite concept. Let's do an example. Sally gets 3% interest rate on her job's retirement accounts. Based on the Rule of 72, how many years will it take her money to double? Based on the Rule of 72, how many years will it take Sally's money to double? Okay, tell me what the number is. Y'all got the formula, that's great. Good job, young lady. She said 24 years. That's a long time. Now, my question for you is, and this is not the investment class because we're here, I got to ask you, what is your interest rate on your job and your retirement account? Do you know? If it's 6, that's cool, but take them numbers, do them yourself, and ask yourself, is that enough? Yes.
Sorry, for clarification, when you're saying 3%, am I putting the number 3 or am I putting 0.03?
3. 72 divided by 3 is 24. 72 divided by 3 is 24. Y'all agree? 24 years for Sally's money to double. Now, I'm not here to tell you that your retirement account is this or that, not my job. I'm just saying if you got $10,000 in there, it's going to take 24 years for it to grow to 20. Long time for that money. We ain't got that time. So what you got to do is, number one, keep coming to Money Matters. Number two, you need to look at your retirement account and to actually know what it is, what's there. How much is it really growing? I could ask Sabrina, she's my golden child today, what is your interest rate on your job retirement account? She could tell me. I know she can. She better be looking at it every 30 to 60 days. Amen. All right. 72 divided by 3 is 24. Now, Banker Secret says that's how her money's going to grow. You have to understand this basic concept because you know if it works for you, it can work against you, yes? This is how it works whenever we say interest is working against you in this case. Interest, here's a definition, the penalty you pay for the right to own something in advance that you cannot afford. You say, Candace, how does this, what does this even have to do with the Rule 72 and interest and all that? What you talking about? I got you. Just give me a second. I'm getting there. Look at this. Y'all wrote this down? We need this. I want a car. I can't afford to pay the $20,000 for the car. What am I going to do? I'm going to finance it. When I finance it, they're going to tell me I got to pay interest. And depending on your credit score, i.e. what Marcus just talked about, is what the interest rate is going to be based on. Either it's going to be 6, but I've heard lately they've been 10, 15, 20%. They paying for the car 30 times. All right. I couldn't afford to pay for the car when I got it in that moment, the $20,000, I didn't have it. I got to pay interest because I could not afford to pay for the vehicle, so they gonna let me get it in advance, but charge me a little more. We understand? Okay. Well, this is the same thing that happens with credit cards. I'm gonna go quickly, because they said, okay, you owe $5,000 on a credit card. How much is a normal payment on a $5,000 month credit card? Let's call it about $100. Actually, if you look at it, they might be a little higher, depending on the rate. $100 a month is the example. You don't have to write this down, but you can. I need you to just understand the concept. If the interest rate, but I do need you to pull out your calculator to help me. It always makes it better. $5,000 is what you owe. You pay $100 a month. Your interest rate is 21%. Break down the monthly rate. 21% divided by 12 is what? 21 divided by 12. All right, 1.75. You got it. Thank you so much. From that perspective, your interest rate, to break it down, you got to pull it to a little decimal. No problem, I did it for you. 0.0175 times 5,000 says that every month I pay $87.50 in interest. Oh, she caught it real fast. She do good math. Y'all looked at me funny and she did the math fast. Y'all ready? What is interest? The money you giving them, absolutely. That's a great way they say it. So if the interest is $87.50, the principal got to be $12.50. Worse than 20. Because you ain't paying no extra on it, you just going to pay the minimum. Well, the reality is that if you take $5,000 divided by $12.50, it's going to take you 400 months. What's 400 months divided by 12? Hello? Hello? 33 years. Now, if you just did this one thing and you took $87, and as much as we love Arvest for paying for that chicken tonight, They don't deserve all of this $87.50 times 400 months, which is $35,000 on a $5,000 credit card. And this does not include if I pay it down or run it up. I'm gonna say that again because you might have missed it. This is the number if I spent $5, left it alone, and tried to pay it off at the minimum. This is the number. But it's really worse than that when I pay it down, run it up. When I pay it down, run it up. When I pay it down and run it up. I need y'all to get it, okay? I need us to get it. Why is it look funny? Let me show you how the companies tell you. Here is a statement. Your balance is $4,415. You pay $143 a month. Y'all see this? Real statement. Real statement. Here we go. On your statement, the bank tells you, the credit card company, they say, hey, if you pay the minimum, it's gonna take you 20 years. Oh, y'all quiet. This in small print at the bottom. I had to go find it. Like, ooh, where is that? That's what they do. You know, use the bank what it's supposed to be used for. Resources that you understand. But when we don't understand, we get caught up and we spend 20 years paying off the same card over and over and over again. Now, it says, hey, but if you pay $188 instead of $143, you can pay it off in 3 years. It's actually not bad. They gave you a debt plan. But a lot of times we don't even look at the statement. We just keep paying the minimum because we're getting by. We keep paying it down, running it up. I'm not saying this to make anybody feel any kind of way. I just need you to be aware and conscious that we do this, and it's okay if you've been doing it, but we can't keep doing it. We agree? Okay. Any questions? I say it with a smile. You can ask, I promise. No? Question, I got one for you. Are you controlling your money, or is your money controlling you? For now. She was honest. She was like, ooh, I don't like it. But we really have to sit back and think about it. And then don't just think and keep coming to Money Matters and hanging out and eating a good chicken. The chicken is good. Okay? But I need us to do the work. It won't work if we don't. That's it. I think I'm done. Oh, am I done? Yes. This is great. Okay. I kind of went quickly. I do want to make sure that we don't have any questions. Seriously, Deacon Thomas, when you get a second. One of the things that we really, really, really want to do in Money Matters is to create an environment that allows for us to give you information, but not only to give it, but for you to take it and grow, right? We want to know, because we're sending you, what is it called? A survey, thank you. Sending you a survey, got a lot on my mind. Sending you a survey to make sure of what we can do to make it better. We shortened it. It's been 3 sessions. Y'all enjoyed the 3-session series? Okay, they like it, okay. We tried it last year. It went over very well. We're going to do it again. But what we want to do is to figure out what you want. So the next session is the business series. It's the summertime. We talk about business tax. We talk about just business, a lot of business. What does it even look like? The gentleman asked earlier, hey, I want to do a flip. What does my income look like? How does that work? We talk about that in the next session. It's going to be great. But that's one of the hype seasons because we don't really talk about that a lot, but we do now. But we want to know what you want. So can you all please do the survey? Please. Okay. Other questions, open questions. It's that time. Deacon Thomas, if you would, come up so we can get ready to close it out. I was quick, boy. I got through that stuff fast, boy. Whew. Yes, ma'am. I have a question right here. If you say it out loud, I'll repeat it for you.
Is it really an advantage to consolidating credit cards and all that?
Good question. I'm gonna repeat it. Is there an advantage of consolidating your credit cards and debts and things like that? I'm gonna pull that one to you. Go for it.
Okay. I think it's a huge advantage if you got the discipline. Okay. Let's say you got $40,000 in credit card debt. Let's say you got $80,000 of equity inside your house, right? That's dead equity if it's not being used, right? Let's take that equity, get a home equity loan, pay off all the credit card debt. Now it's tax deductible, and you just gave yourself a raise. That's called smart debt. Got it? So consolidation loans work if you are disciplined. Here's what happens most times, though. People get a consolidation loan, then they turn around and go get other credit and run it back up, plus the consolidation loan.
That's right.
You can't do that. You can't get hit.
So Deacon Thomas, let me tell you what I did one time.
All right.
So he said this great strategy, right? He was like, take the equity out your home. All right, I got a couple, let's do that. Okay. And then, so I took it out. And I said, okay, I had, let's call it $20,000. And then when he says you weren't disciplined, so I took the 20, I paid my cards off, okay? After I paid my cards off, everything looked great. The card balance was at zero, I'm paying one payment a month, and then some stuff started happening. Instead of me being disciplined and sticking to my guns and doing what I need to do, I swiped the credit card again. So now, like he just said, now I got a new credit card bill that I called myself paying down and being disciplined on, and I got the mortgage payment, the extra one that I was using to pay the debt off. Does this make sense? So what he's saying is don't do it and then go do the extra again and swipe and put yourself back in the same situation.
Absolutely. Another question?
When do student loans start affecting your credit score?
When you don't pay them.
So like I'm saying, like did it happen after you graduate or like this?
So, good question. When do student loan, I have to repeat, when does student loans start affecting your credit score? So, normally they give you a 90-day, 120-day, depending on the loan. They give you a little time after. You have to make sure you communicate with them, and you want to consolidate your loans. Normally we talk about this. Get your loans, put them together so they're all together. If you don't communicate and you don't talk to them, normally about 6 months after, they're on you and they start affecting you negatively. But don't ignore them. A lot of times, especially if you're not working, you can do payment plans to where your payment's zero, but you're still on time. Yep. Definitely do that. And if you have more questions, reach out.
Good advice.
Mm-hmm.
Good advice.
You're welcome.
More questions?
It's a good time for it. Oh, look at us.
Couple good minutes.
Mm-hmm. Okay.
Write this word down called asset. Asset. And write down liability. Now, can someone let you tell them what the difference is, okay?
I sure can.
Please tell them the difference in an asset and liability.
So an asset is something that makes you money. Simple. I want to keep it simple so that you can remember it. Assets make me money. Repeat it. Again. If assets make me money, what do liabilities do? There you go. Liabilities take my money. Simple. Liabilities take my money. Repeat it. Liabilities take, again. Got it. Assets do what? Liabilities do what? We got it.
Now, the reason I wanted to talk to you guys about that because she gave an illustration of a credit card. $87 a month went in interest payments. $12 went to principal. You just became an asset of the financial institutions. Y'all just catch that? You became a legal asset with a contract where you owe them money. So the objective is to take control of your money. The objective for a class like this is for you to get radically angry at the financial institution and education system because you should have been taught all this stuff from the elementary and up. But it was purposely not taught to you so you can become a consumer and an asset to the financial institution. I'm sorry, Marcus. But become the CFO of your life. And the only way to become the CFO of your life is that you control your money. There is a systematic system for you can control your money. Find out where the money's at. Come up with a game plan. If you got debt, pay it off. Because the one thing, Candace, we'll get a chance to talk about in another class, is that if you pay all your debt off, and let's say a mortgage, for instance, just say you pay your mortgage off in 10 years. You had inside your mindset, you were earmarked to pay that mortgage off in 30 years, weren't you? But if you paid your mortgage off in 10 years, the next 20 years of money you had earmarked for your mortgage will make you a millionaire. The debt that you had earmarked just to pay your mortgage off will make you a millionaire if you change your mindset on how you see your money. Yeah, this stuff is real, guys.
Mm-hmm.
It's real. The average Social Security check right now in this country that people are receiving is between $1,400 and $1,500 a month after working 30, 40 years. And it's that because the federal government forced you to take money out of your pockets, forced the employers to match your Social Security because they know the saving habits of the average American person were horrible. So they forced us to save money, and they forced the employment system to put money in your system. But it doesn't have to be that way once you get the knowledge. See, once you understand the power of compound interest, once you understand the power of a 3% interest rate versus a 32% interest rate. You heard what I just said? 32% interest rate. Or a 30% interest rate for the last 10 years in some funds. All that stuff is available for you to learn. There are a lot of investments hidden in plain sight, right in front of you, and you don't even see it. How many people go to Walmart? How many people go to Kroger? How many people go on Google and search? Did you know if you put money in Google, Walmart, and Kroger for the last 5 years, your money would have averaged 32% a year in growth in just those 3 stocks. See, you cannot afford not to learn this stuff. See, this is important stuff. So I just want to make sure, stay plugged in. We got another session coming in the summer.
Mm-hmm.
There's a big investment session coming in the fall, right? September. Guys, you got to take this stuff serious because the financial institutions are stealing your wealth. Over here, question. She said, what if you want to pay your house off early, especially if you don't have any excess debt? The first thing you want to do is go to a biweekly mortgage.
Yes, sir.
Just by going to a biweekly mortgage, you just created another monthly payment that you pay on that mortgage, go straight to your principal. Secondly, yes, you want to take an extra $100 like Candace talked about, $200, and pay it towards your principal. But every time you write that check, make sure you put on the very bottom of it, apply it to the principal. When you pay it off your credit cards on the very bottom of that check or inside your portal, apply to the principal. At the end of the year, come back and audit the banks, audit the credit card companies, and make sure they applied it to your principal. Good question.
So, Deacon Thomas,
Yes.
should I be trying to pay my mortgage off if I got all these credit cards?
Absolutely not. See, the mortgage is an installment debt, which means the payment's going to stay the same all the time. The revolving debt that Marcus talked about goes up and down, 29%, it may go to 35%, whatever they're doing. But you got to get that stuff paid off because you are an asset. Canada just showed 21%. But these credit cards out here are 29 and 32%. They're stealing your wealth. So use the snowball method, taking that $100, applying it to the least debt you have, the smallest debt, and every time you create a margin, take the excess money and just apply it to the next debt, the next debt, the next debt. Oh, you came up with $100. But $100 got you debt free in 10 years. In 10 years, you freed up almost $3,000 a month to reinvest. And that's when you get your freedom. That's when you get your freedom. Yeah, that's when you get your freedom. Any other questions? Hey. Yes, sir, in the back.
When is the summer class?
Summer class was
I
scheduled
think
for
they're
that?
talking about the 1st of June.
1st of June?
Yeah, 1st of June. But
Yeah.
we'll definitely send it out, especially if you register for this one.
Absolutely. In that summer class, too, you're going to find out about home-based business, how they work for you. Yes, sir.
How young can you start building credit history?
Oh, my God, you can start building credit history as soon as you get 16, 17 years old, especially if somebody co-sign for you. So definitely build good credit history, but be responsible. Very important. I thought you were going to ask me a question. How young can you be when you start investing?
Investing, right, right.
That's
Well,
what I wanted.
He mentioned, you
Go
know,
ahead.
it's crazy. He mentioned the flip.
Oh, yeah, he's an investor, young
Oh,
investor.
yeah, that's good.
Good deal. Congratulations, young man.
What would you recommend for a 17-year-old to start building credit history?
Building credit history? I would save my first $1,000. I'd go to the bank, I'd collateralize it, and I'd tell the bank, I've got $1,000 here. I want you to lend me $1,000 and use my money as a collateralized, guarantee you're not going to lose any money investing in me. Well, it's actually a secured loan using collateral, but it's a bank loan. So you start looking, when creditors or people are going to give you credit, start looking at the loans, they look at the type of loans you're getting. See, a bank lending you money has a lot more credibility than somebody around the corner lending you money. You know, the bank trusted you. Yeah. Second thing I would do after that, if you're responsible, if your parents got good credit, kind of piggyback on their credit, what they call authorized user. Yeah. But parents, if you let somebody piggyback on your credit, make sure the bill comes to you every month. Make sure you're looking at it every month and make sure he's paying that bill, okay? And make sure it's automated.
Deacon Thomas?
Yes.
I didn't let nobody get no card on me. I said, send the card to my address. They can just piggyback. They don't need no card.
Oh, you hear what she said? She never issued a card for that person to use. You just piggybacked off the credit and built your credit score. Yeah, good advice, Candace. Good advice. Any more good questions? Good questions.
Deacon Thomas, I wanna just make sure we understood it. So you said instead of getting a secure credit card, which is what everybody thought you were gonna say, you said get a secure loan from the bank because it's a stronger credit base whenever people look at it. Like the bank gave you a loan and you paid it back. It's stronger than a credit card.
Absolutely. Am I right, Marcus?
It's perfect.
And the rate's gonna be cheaper too, so.
Hey, the bank is giving you inside scoop.
He said, because they didn't hear him, he said the rate's going to be lower on that secured loan than it is on that secured credit card, so it's much better for you to get that secured loan.
Absolutely.
I don't know if y'all know it, but he had never said that before. That's new.
I got one question before we close out. We've got to close out here. Can somebody tell me what cash flow is? Cash flow. What is cash flow?
Income minus expenses.
What did he say?
Income minus expenses, which we have coming.
You know what he said? Income minus what? Expenses. Young man, you get that $25 card for you.
My God. And Josh, you were supposed to get that.
Thank you for being a good participant. Any other questions? We've got to close out. We're past time. Any other questions? Don't miss the next session, okay? If not, we'll pray and we'll get out of here. Hey, let me tell you one thing. Where's Chandra Martin at? There she is right there. Guys, she's finally coming to see me. How many years has it been, Chandra? We won't even start moving. Anyway, we got to say that. Go see these guys, the instructors. You got questions and stuff. They'll sit down and talk to you, okay? Father God, thank you for this day. Thank you for your grace. Thank you for your mercies. Father, thank you for this ministry. Thank you for the insight of this ministry, Father. Pastor Pointer, Pastor Thomas, the discipleship ministry, Father. Thank you for all these instructors who took their time out, Father, to just share the benefits of understanding finances. Father, we pray that something has been said that they can take and share with somebody inside their circles. Father, we're going to teach them to share just to somebody inside your circle. Teach them about money. Father, money is similar to oxygen and water, whether we like it or not. There were that's almost 3,000 verses in the Bible strictly about money. Because you knew that was the one thing that would rival our relationship with you, Father. We hope this class, Father, has simplified the biblical process of how we spend money. We pray that every person here, Father, find their homes like they left them this morning. Your son, Jesus' name, amen.
Amen. All right. Thank y'all so much.
Class.
Yeah, you keep forgetting them.